Hello and welcome back. My name is Josh and this is Finance Soup, and I wanted to do the last in my three-part series on how interest rates impact investments. So we previously discussed how interest rates impact housing prices, then how they impact stock prices, and now I want to go a little more in depth into PE ratio. So again, as a reminder, PE ratio is your price to earnings ratio. It's the price you're willing to pay for $1 of earnings. So right now, Walmart's at $149. It's got 42 PE. So 142 divided by 4, or 149 divided by 42. So it's got about $3.50 of earnings per share, because this is the price per one share. And if we look at Walmart, we can actually see over history what their average P is. So it's 13, 12, 11, 10, and then shot up and then around 20, and then up to around 41. So what is a good PE, you could say? Again, you theoretically you want as low a P as possible because a P is another way of looking at it as if the earnings stayed the same, it's how many years to make back your full investment. So at a 10 PE, you're getting $1 of earnings for $10. You're buying $1 of earnings for $10. So in 10 years, you'd make back 100% of your earnings. At 40, it would take 40 years to pay back just in earnings. Now, obviously, earnings can grow. We can see here. Actually, I wonder if Walmart's earnings have grown. We can see here their operating income actually has not grown. It's actually been down from those years, which is one of the reasons why PE can be low. Again, if a stock is growing quickly, like a Tesla, it has a high PE because it's saying it might be 385 times today's earnings. But if you double earnings next year and then you double earnings the year after that, it goes from 385 to, let's say it goes to 190 and then to 90 and then to 45. It can quickly go down if you keep doubling. So companies that are fast growing, like a Tesla, will typically have a high PE, and companies that are slowing or even losing money, like they were here, will have a low PE. And you could see that this is kind of the time frame when Walmart had a low PE, and then in the last couple of years, it's gone up, and their earnings have gone up accordingly as well. And actually, if we look at Tesla, you can see how much their earnings are going up. They're going up a ton. What is this? Quarter over quarter, 200%, 60%, 109%, 300%, 147. That's why their PE is so high, because we're expecting earnings to grow so quickly. But we're here to talk more about how PEs are affected by the interest rate. So again, when interest rates are low, it drives stocks up. Why? One of the reasons is what we call multiple expansion. Again, multiple is the multiple you're paying on your earnings. That really is PE. I've previously called it exit multiple. Exit multiple is a better term, I think, because we're looking at the PE in the long term. A PE today, I don't think is a very good metric. It says what you're willing to pay today for an earning today. But companies are growing, they're going down. I don't really care that I'm paying 400 price to earnings for Tesla, because I think it's going to keep growing earnings. So I want to know, what am I paying in the long term? So what's my price to earnings in the long term, which I call an exit multiple. So in 20 years or something, when Tesla's a stabilized business, then what am I going to be paying for $1 of earnings in Tesla? That's what I want to know. So I actually took some data from, there's lots of sources out there on what's the PE over the last 50 years, as well as interest rates. And we can see here's a chart of the PE ratio. So we can see actually, this is today and this is back in the day. So it was around 20, then it dropped below 10, then it rose up over 30, down, up over 30. Now it's around here. So that is, you can see it's changed significantly. But actually, if we look at the correlation, where is it here? Oh, here. The correlation, I did a little chart. Correlation between price to earnings and interest rate. You can see it's a pretty strong correlation. Is it perfect? No. But there's a very strong correlation, again, between price to earnings and interest rate. Again, intuitively, this makes sense when interest rates are high, when you just put your money into a bond. And if you did want to buy a stock, you'd need to get a lower price per earnings to compensate for the risk of a stock. When interest rates are really low, you're willing to take on more risk because you don't want to make 1.5% on your money. So again, you can look at this and we can actually see, I did a little study by decade. So again, it's not perfect, but in the 70s, interest rates were 7. PE, I expected based on this formula to be about 17. It was 11. 80s, 11. It was actually 12 based on a 10% interest rate. That one's spot on. 90s, 5. Expect to be about 20. 21. Again, spot on. 2000s, 25, 31. Not spot on, but again, it's higher than average. 2010s, this one was a little off. And 2020 so far, very low interest rates, and we expect a 30 PE, and we're getting a 30 PE. So again, there's a pretty good correlation. Is it perfect? No. But we can actually see here, there's another one based on the decade, or on the year, sorry, the odds of it being over under a certain PE based on the thing. So 100% of the time it's under 5. When it's a low PE, it's got a very high chance of being over 10. Actually, when it's very low PE, when it's under 5% interest rates, 75% chance of being over 15 PE. And when it's under 2.5%, it's got a very good chance of being over 20 PE. Again, only when it's a really low interest rate between 2.5 and 0 is it got a decent chance of being over 25. So again, what is this saying? Kind of the inspiration for this was I watched a video from, I think the channel's called Everything Money. They use a stock analyzer tool, and they're always using PEs that are very low in my opinion. They're using 12, 15, and 18 or something like that. These are extraordinarily low PEs when you look at data because they're using 100 years worth of data. That's ridiculous. When we actually look at the last 50 years, the average PE, has been 19.4 PE. So that's, again, 20. So that's the average. And in the last 28 years, since 1993, it's been about a 25 PE. Again, this is a pretty good set of data. We're not picking a year or two, 28 years. And again, there's a logic behind it. The logic is interest rates. We are in a much lower interest rate environment. As we can see here, interest rates have continued to drop. I don't think we're ever going up to 13. Do I think we're going to stay at, or sorry, this is bond rates, but this is interest rates. But still, it was 19% interest rates back in the 80s. Do I think we're ever getting up there again? No, I don't even think we're getting up to 9. Could we get up to 5? Maybe. But I see us being in kind of the 0 to 4 range long term. That's where I see interest rates. And so if you see a 0 to 4 interest rate, what kind of would the expected PE be? So again, let's say you expect a 3% interest rate long term. I think that's a reasonable rate. Then you expect about a 25 PE for the average company. Again, I wouldn't use 25 necessarily for every company, but that's average. More and more of the economy is becoming a tech company, or is profits are made from tech companies like Apple, Facebook, Google, and tech companies typically have higher PEs. Retail is making up a smaller percentage of the economy, so it's still best to use a PE that's specific to that industry. So, software maybe is 25, insurance is maybe 15. So still use the, the PE that's specific to your industry. But if you know nothing else about the business, what's a good PE? I think between 20 and 25 is a good PE. So again, let's say it's a 4% interest rate, you think 22, 5%, 20. So again, I think interest rates are going to be between 2.5%, which is about 25, and 5%, which is about a 20 PE. So to me, I would say, again, unless you have a reason to think that this industry should have a much lower PE, or this business is shrinking and therefore I want to give it a discount, so I'm going to give it a lower PE, I would definitely use a PE between 20 and 25 for the company. Again, here's my little framework. It's 30 if it's a super, super, super elite company. I use this for almost nothing. The example is Tesla, where even in 15 years, maybe the business is stabilized. I still think they're going to be innovating, and maybe they deserve a super high exit multiple of 30. 25 if it's software or an elite company, so that's Apple, Facebook, Google, Microsoft. 20 for an average company is what I say, a good company, PG, Procter and Gamble, Coca-Cola, something like that, or Nike maybe is a better example. And lower than that, 15 if it's a crappy industry, like an industry with lots of tailwinds where you think maybe this industry is going away, like cigarettes or something, or it's a declining business. And then any other number, like a 12, a 10, low, that would be like high risk of bankruptcy, or if it's that specific industry. Some specific industries do have very low PEs just because of the idiosyncrasies of that industry. But again, I wouldn't use that. So typically I'd use 20 to 25. I'm typically looking at great businesses because that's what I want to buy. So that's what I typically use is between 20 and 25. 22 maybe is a reasonable number. But this hopefully has showed kind of when interest rates are lower, it impacts the price you're willing to pay on earnings and has this impact the exit multiple. Hopefully this was helpful. Thanks so much for watching. My name is Josh again. It's been Finance Soup, and talk to you next time.